Today, I'm going to teach you a technique that will help you and change the way you do scalping and will put you ahead of everyone in the most difficult and complicated market time frame to master. Being able to win every trade you choose and choose only the best ones, showing you real examples of how it's done. And before moving forward, this is very important for me to tell you. Trading on M1 is the most difficult, complicated, and risky experience a trader can choose. And as if you were an automotive engineer about to create an incredible race car, you need a map. You need to know where and when you're putting each screw inside your high performance engine. In our case, you don't need to put screws, but something much more valuable. You need to choose the correct place to put your money, in this case, each trade you choose. The concept of a map is extremely important here. We need to see and clearly understand what you're looking at on your screen. This is why I'll explain next how to get that map and know exactly where you are and where you're going, of course. It's commonly said that M1 is only noise, and I don't completely agree. I consider it noise only in specific circumstances. Remember, each time frame from higher to lower gives more and more information as you go down, and I've been able to use 1 minute in a valuable way when even in 5 minutes I can find enough data to understand what's happening. And let me tell you something I live so you understand how valuable it is to know where you are. I had a funded account where I tried to apply an absolutely effective and fantastic strategy that I tested for 1 month. And when I went to the real market, nothing went the way I wanted. I lost and lost and lost, and I didn't even know why. The reason, that strategy I practiced so much. I practice in a specific market period when once the market structure changed, it stopped giving me the same patterns and the scenarios I had trained for absolutely disappear. I was in absolute pieces. I practiced everything on the chart of 1 minute. I practically never went up to M5, for example. Therefore, I was incapable of knowing what patterns I was seeing. I didn't have a map. I prepared for a war where I didn't even know who my enemy was. When you're trading M1 because you like going fast, that's fantastic. That's fine. But you must be fully aware of what's happening higher and why, or the market will destroy you. So let's go straight into talking about this and defining what this map is, this technique that I was talking about. So I will divide it into three simple things. And it is understand how structures behave on M1, how to use the M1 timeframe and not lose, and real examples of how to use it. Obviously, institutions don't move on M1. M1 reacts fast because with very little it generates a big movement. Institutions and even retail traders with big funds move on another frequency. They see the market on a much larger scale because the amount of money they have generates a stronger impulse, and therefore they must rely on higher timeframes. This means that outside of Asia or London, it will be rare to see valid structures on M1. Only in Asia or London will you see structures that M1 actually respects. And even then, you are much more likely to confuse an M5 or M15 accumulation with a directional market of on M1, for example. What does this translate to in terms of patterns, structures, and movements? Simple, an order block on M1 means nothing, and I'll tell you why. Order blocks are zones where institutions decide to sell at a price. ICT teach that it's where they load many orders, but that leaves us something important. They load orders, and it is the price where they are willing to sell and prepared to not let price go beyond that point. Therefore, it's a zone they defend and use. OVs, as Wyckoff's system, are a hyper-simplified accumulation, but we can observe it in the market, and I'll show you. If you look at what an H1 OV is when you open it, it's nothing more than a series of orders in a range, meaning an accumulation. We see at different zones where orders were loaded even in M15. On H1, everything becomes a structure zone, an OV. These high loads level are extremely important. And as I explained before, institutions move big money, huge amounts, and M1 doesn't give them the ability to build valid structures. And if they do appear, they're surely not very important or relevant. As I say, there can be cases where it is important, but only because there is no liquidity, no competition, or people with big money moving the market. In this case, an accumulation or OV end up being a protected zone where they push up loaded orders and then push down a bit more to close their positions. Again, this will not be the norm, but it can certainly happen in some cases. Let's go to the case of an FVG, highs or lows. Let's start with the fair value gap. When you see it on M1, it's very easy to completely misunderstand the real size of an FVG. You may see this and think this is the whole thing, or think there's one here, and one here, when in reality, it's a huge fair value gap. And if price touch it partially like it did here, that's a very important signal to know if the market will go up or down. In this case, the fact that it doesn't come back and fill it completely clearly says the market will go up. Knowing this, with a little stop loss, you can get a much bigger take profit. But why I am so sure about this? And fair value gap is a void according to ICT concepts. But what does that void mean? It's always said these are zones where orders weren't filled, and that's exactly what happened for institutions. They don't use brokers that give them the best price available. They use an interbank system to place order, and these are zones where their orders do not get filled, which creates a movement that initially harms them because they didn't get to load their positions, and that generates an adjacent condition. And I want you to pay attention to this. They will return to the fair value gap to fill their orders. If they don't return, or if they fill it only partially, it's because there is much more potential in another zone in the direction opposite to the FVG. It means there is something far more valuable on the other side. It's like leaving a bag with 500,000 on the ground because on the other side there's a huge box full of gold bars. Inefficiency zone, as they are also called, give signals by themselves about where price will go. Understanding this make it clear why it is inconvenient to limit the size of a fair value gap just because you saw it carelessly on M1. It's important to see the full scale, not only on the 1 minute chart. Now talking about highs and lows, it's much simpler. A high or a low, no matter which, has no relevance on a scale where they're created easily. They break easily because they are created easily. Believing there is a continuity in a direction just because you like to mark a break of a structure on M1, no, I'm sorry, that will not lead you to an effective result in most cases. It will almost surely lead you to losing the trade. The reality is that randomly and without context, you might take a trade simple because the previous low broke and you get it, while in many other cases, you'll get a false signal or manipulation. And this takes me to the next point. The most important thing as a trader is to trust that the market will move in the direction you speculate, to trust the movement it will make the market. What price does in M1 is less reliable than a hungry domesticated lion. When you observe the market of M1 and you truly believe the market has moved, I'm sorry, but let me tell you that it took 3 baby steps and barely generated any meaningful signal, or it moves so fast due to the liquidity injection that what you see is chaos. I've surprised myself seeing how an M5 or M15 trend can be nothing more than a week on higher timeframes. And up to this point, you must be thinking, But are you recommending that I shouldn't use or trust M1? Where is the technique then? Use M1 as much as you want to observe the market, to place trades and to see how price moves, but never to decide with serious criteria where and how the market will do things. From here on, I'll show you clearly how using the market of M1 the correct way allows you to mortally precise, accurate, and able to win trades. I'll give you 3 examples of how to use these criteria to get effective trades. This case right now is very interesting. We're entering a London session. The market was bullish. It already made the bearish move, and we're at the point where institutions will look to load orders or get more liquidity from the movement. It could give the impression that this is just a retracement before continuing upwards, but if we look closely, price is stopping at an OV. Which one? If we look only at the 1 minute order blocks, we might try to mark. Doing so in this zone will equal losing the trade on the re-entry because price never reached it. But marking this one here gives us an opportunity, and here we could take advantage in M1. But this OV has much more context and information that give us real confirmation. If we look at it on 5 minute chart, we can see an accumulation zone, a place where orders were loaded before pushing up as the final bullish breath. And this is a zone where if price wants to load orders, it will do it there, as we saw confirmed in M1, because orders loaded there before and price returns to that level. Or simple, they defend that zone and make sure price doesn't go beyond it. And this is information we wouldn't have if we only look at 1 minute time frame. This information defines what really happened and doesn't give you just a glimpse. We can also see how an inefficiency happens on M5, much larger than it appears here, but here one also happens, and if we follow it and fair value gap happens here, it fills completely and it stops at the order block we marked earlier. That means they use the order block to manipulate, make traders believe price will continue up, stop at the defended level and drop again. It does another retest only to take out traders pushing upward, and then the market finally drops. Order block and fair value gap in 5 minutes guided the path for M1. They gave a clear panorama of what needed to be done to not be completely disoriented on the chart. Let's look at another example like this. Imagine you're before New York session looking for a trade, trusting that the last 5 highs the market created are a safe stop loss zone. It seems logical after looking at 1 minute. At this point, you might expect a drop and finally price ended up going up. Based on my volume reading, which is an essential indicator for me, I know it took liquidity from those who believe it will sell, and it also took liquidity from those who believe it will continue rising. Why? A novice trader or one lock in his M1 vision, even me in the past, would say, I don't understand anything. What is the market doing? It's crazy. It makes no sense. I don't understand nothing. And the true limit, the real zone where price wasn't going to advance anymore, and this is something completely institutional, is this zone, the other loading zone, the price they defend and where they sell again. And now the previous 5 highs stay loading within this accumulation. But this in turn respected the hierarchy and came as a consequence of the most important zone. How do we know it's more important? Because many more orders were loaded there. The largest accumulation together with the last one creates a pattern you can see clearly on M5. You could absolutely avoid falling into confusion that could cost you a lot of money and above all, frustration from feeling completely lost. Sometimes we don't even need more system. We just need to understand the market panorama the right way. This is a simple but very clear example of the need to have a map that guides us. I want to give you one last example once again, and this is a really interesting one. I'm going to emphasize the 15-minute chart. If we're on M1, entering early on the chart, it's 8 a.m. and we're seeing the market fall. We might try to look for an entry, but don't know where to put the stop loss. We could end up placing in a zone where the market will never go, giving us a terrible risk reward. But how do we know? If we only go to M5, we can see the accumulation zones that apparently were swept. Something interesting is that when you identify a real order block or an accumulation, as I prefer to see it, depending on context, these are places where institutions remain interested in buying or selling. Given this, we have two zones where price is likely to form much visible highs or lows in M1, since they aren't clearly identifiable here. And if we finally go to M15, they're not two. It's one single large order loading zone, a place where price was stuffed and where they decided to place orders they will later sell. And the high created after this loading was just a sweep, just a wick, removing any intention to continue rising for now. So this zone, or these two zones on M5, are places where valid resistance will form for a trade. And this is valuable information we have. Information that benefits a possible entry and makes the work easier, giving us the ability to truly understand how and when the market will actually act. That's it. And I want you to pay attention to this, understanding that these time frames are your best friends and not your enemies for any type of strategy you use will give you an edge you will have never expected to have. I know I only talk about basic concepts like order blocks and fair value gaps. So if you think there are others even more important, I love to read it in the comments. And I'll show you clearly how in any market pattern using higher time frames to guide you and mark those patterns will help you in an invaluable way. If you like the video, like it, subscribe, and if you're interested in finding more content like this, I'll leave more videos here for you to watch. And I hope to see you again.